2, 1.
Hey, so here we are dancing as the show goes live, and I'm reminded of my Facebook post today, which is unpopular opinion alert. I never really did think Elaine was all that bad of a dancer. I think she kind of gets a bad rap. Maybe,
Dude, you gotta love Elaine.
yeah.
I mean, she's my hero dancer, my dancing hero. Like, she makes me look good. I love it.
That's awesome. Hey, so ladies and gentlemen, this is Judah Hoover. I've got Josh Weidman over here and Brian Lochner down below from Note School. Josh and I are hosting Brian this Saturday for a all-day event from 9 a.m. to 3:30. And as we were putting together and going over some stuff, Brian said, hey, listen, there's some new information that we got to go over and some stuff to talk about. So we wanted to have him back on to talk for about 10 minutes here today on the show and just kind of cover some of the information. But Note School is a great training program to learn about creative financing and ways that you can buy and sell in the note business. It would be awesome if my co-host would bring up that banner that we have with the URL.
Oh my God. Sorry.
So you want to go to www.noteschool.com/BGRES to get registered for this. It's a free event. Now, Brian is talking to a number of different RIAs all across the U.S. Yeah. And a lot of those RIAs are charging $5, $10, $15 for their members to have them register.
It's like $49 and $79, but
is it even that much? Wow. Yeah, we're doing this. I'm trying to undersell it. We're doing this for free. And so we want everyone to be there and participate. So, Brian, talk to us about the latest and greatest of what's going on in the note business.
Yeah, man. So we talked last time, and I said a couple of things. And obviously, when I only get to talk for 10 minutes, I'm like, oh, there's so much more juice I could squeeze out of the lemon that I just want you to have, you know. But it's one of those things. We were talking about creative financing, and then we started talking about notes and what's going on. And I just started realizing, like, okay, probably the smartest transition here is. I said we're in this mortgage crisis in slow motion, right? That's what Eddie Speed's been calling it. And there's been several articles that came out that were just like these flashing red lights that basically no one talks about. This was one of them that came out. This was in August. That was talking about just the FHA mortgage delinquencies, right? And that they're reaching this highest level since 1979. And really all that means...
1979 was a good year. I was born that year. So 41 years ago. So you're saying FHA mortgage delinquencies, people being at least 30 days late on their mortgage, is the highest that's been in 41 years.
Wow. Yeah, that's right. And obviously you get this extra tie-in with the forbearance programs as well, because these people who, again, in theory, they're going to be able to get back to some sort of normal and start paying their bill again. But the misunderstanding of forbearance is, well, I don't have the money now, but I'll have it later, which is like the famous American line, right?
The check's in the mail.
The check's in the mail, exactly. And so it's like most of the forbearance programs were originally 3 months, and you had an option to extend for another 3 months, which means that on month 7, again, you owe that 7 month plus all 6 months. And so how many of those are obviously going to just fall into I don't have 7 months worth of money because I didn't have 1 month of money, right? In fact, when you go to the next slide that I put up, this was just like a couple weeks ago I was reading. It was just talking about just the FHA mortgages that are delinquent in some of the different markets. And this actually walks through a lot of the major markets. But I thought it was fascinating where I circled it. It said just FHA, not including other delinquent mortgages. And then also on top of that, what about when the forbearance program's in? Then there's going to be this entire other wave, because again, if they're in forbearance, they're not in foreclosure. And right. And on Saturday, I'm going to show you some charts and some graphs that actually walk you through the bigger picture, right? So you start to look at some of the forbearance programs, and it looks like, oh, look, all these forbearance plans, people are getting out of forbearance plans. And so it looks like things are heading in the right direction, when really, if you'll understand how this really works, is the only reason forbearances are going down. Not the only reason. There are some people that are getting out of the forbearance plan. They're back at work. They're making their payments, of course. But there is obviously a giant chunk of those that their forbearance it's not gonna happen. And what's happening is the banks are taking them out of a forbearance program and they're putting them on their bank book. So basically they're moving towards the foreclosure process, right?
Yeah.
And that it makes it look like things are getting better when forbearances are going down. But again, the non-performing side, there is this massive wave that is coming, and it's really kind of starting to unfold this quarter. It's going to start to unfold. And so I think by really understanding how the non-performing side of the world works, what happens when there's all this bad debt, how does the investor community like us step in and solve these problems that the banks aren't really set up to solve? Because the banks are not in the foreclosure business. If for any reason if there's a misunderstanding, the banks are in the banking business, and we want them to stay in the banking business.
Right.
They're not in the housing business. They're not in the business of foreclosing. Does that have to happen? Of course. But you're going to find out on Saturday. I'm going to show you really what that path looks like and the accounting process that goes with it to show you when you can anticipate basically big deals again, right?
Right. So we shouldn't wait until this happens to learn about notes. We should learn about notes now so that we can, I know this is the most, I'm even cringing myself with how leading of a question this is, but we should learn about this before the time happens instead of saying, oh, well, maybe I should learn about notes in the future because, when it happens, I'll learn about it so I can take advantage of it. We want to learn now so we can take advantage when it actually
Judah, I mean, it's not even that leading of a question. Like, this is some common sense stuff, right? If you're just now Googling how to get into Amazon dropshipping, you've missed the wave. If you're just now trying to figure out we should probably get into Bitcoin, you missed the wave, right? It's one of those things of you're going to look back and be like, oh man, there were so many foreclosures during that time and I could have bought them for 30 cents on the dollar.
Mm-hmm.
Well, if you don't have the education when the opportunity presents itself, then yeah, you're just going to be stuck on the sideline. And this is really your last quarter. You have this quarter to really educate yourself, get the information inside of your head, and get confident in what you're doing so that when the opportunity presents itself, you can pull the trigger. And if that happens in December and not February, okay, great. You're ahead of the curve. But if it happens in February instead of December, well, you're still ready. So many people complain about, oh, if I could just go back and, do the 2008 thing all over again. Well, this is your giant hint.
Well, it's funny because you hear it every time that we have a real estate boom, like we're going through right now. I mean, I remember this as a kid. I saw this, during 2008, or prior to 2008. And you see it now. A lot of people rush out and they want to be real estate agents. Like, okay, I can, I'll take the class, I'll list a house, I'll sell it for you. But the reality is those people that are plugging away and know what they're doing, they make big money during this time because they've already done the work and, and they know what they're doing. And it's very akin to what you're saying right now.
Yeah. Yeah, absolutely.
I want to make 2 points here, Brian, and hopefully this doesn't cut off. So I've been paying attention, and I'm sure my co-host Josh has been paying attention to the kind of the information business for a long time. And one of the things that always just amuses me is when people don't update their slide deck and they utilize kind of outdated news things. We're looking at a September 25th article here, and that other article was like from the end of August.
Yeah.
So this is like real and timely stuff that's happening. This is what you want to be learning about and getting your feet wet with right now. The second thing that I want to say is that last article referenced that New Jersey is leading the way. I think that it's very, very lovely about the note business that we can live here in central Pennsylvania. And I want my rentals to be here in central Pennsylvania. I want my flips to be here in central Pennsylvania for all kinds of logistical reasons. But there's nothing that stops me from buying a note or buying a note and then turning it into a reperforming note in New Jersey. It kind of expands the pool we can swim in. Would you say that that's fair?
Yeah, and I think I can't remember if I mentioned this last time or not, but the non-performing space, the non-performing loan space is going to be your easiest, lowest cost, barrier to entry into the real estate space. It doesn't matter what your exit strategy is. If you want to own rental properties, own rental properties. If you want to play the bank and just own the notes, do that. Like if you want to do Airbnbs, it doesn't matter. The one thing we can all agree on is if we could buy the house cheaper, our numbers would be better, right? And so you can go beat the street and spend $10,000, $20,000 a month in marketing to try to talk to sellers and talk them down to get the prices lower, or you can learn a new skill set, add it into what you're already doing, and start to capitalize on the opportunity that happens to be available right now, right? The thing about Note School that I absolutely love, starting as a wholesaler in 2014 and trying all these different other strategies, is Eddie was never one that said, Brian, you got to stop all this craziness. You need to start doing what I'm doing, which is like the typical strategy guy, right? He's like, I got the new shiny thing. Eddie says, look, let me teach you a new skill set. It's going to make you better at what you do. It's going to make you a better wholesaler, a better rehabber, a better landlord. And yeah, I'm going to show you these other strategies to where if you don't want any of these things, if any of these are negative, I'm going to show you how to play the role of the bank, because the banks seem to rarely lose, right?
Yeah, right.
Yeah, no, that's excellent. That's really good. Josh, do you have any follow-up questions before we let Brian go?
No, that's really good stuff, Brian. I'm looking forward to Saturday. Thursday we'll dig in a little bit deeper, but I appreciate you coming on here today.
Yeah, thanks guys so much. Y'all have a great one.
See you, awesome. Brian.
See ya.
Bye-bye. All right. Yeah, it's always good to have Brian on.
Yeah, absolutely.
All right. So today, we're getting into doggone it. My brain's in two different. We're going to continue our conversation from yesterday. We're going to get into the three aspects of a limited partnership to consider before investing with a sponsor. So we talked yesterday about what is investing in a syndication deal, right? Today, we're going to dig deeper and take a look at some of the negative aspects. That's pretty much it, right? All right. Okay. First and foremost, the LP is a silent partner. So just kind of transition.
The LP is a limited partner.
That's right.
LP stands for limited partner.
Yep. Okay. So the LP or the limited partner is a silent partner. This is a very, very important part of the puzzle to understand going into this. The entire amount of control that an investor has in an LP or a limited partnership deal or a syndication deal is before they invest.
Right.
Because once they sign on the dotted line, once they buy into that partnership, well, there's already a plan there. That plan is what's going to be executed, and that sponsor is the one that's going to be executing it. So you first have to read and understand all of the terms of the agreement. And, we'll get into some of the terms that can be not so favorable and hidden into the agreements in a minute here. But you have to read through it, understand the terms, understand the concepts, and then ask yourself, is this realistic? Right? Absolutely,
because what you're buying is that plan, and you're not going to get to pick paint colors, and all that simple stuff. Number one, but number two, you're not going to be able to pick the contractor. They're not going to use your guy for this, that, or the other thing. That's kind of like a medium level thing. But also you need to understand at a very high level, 4 years from now, when it comes time to sell or refinance, that is not your decision. Now, a smart sponsor will poll his limited partners and kind of take feedback and insight on what they would rather do. But it is ultimately the sponsor's decision and the sponsor's choice what happens, for good or bad. I've been an LP on many syndication deals. I've made a lot of money being an LP in syndication deals. I absolutely love it. Don't misunderstand me. But you need to understand that you are a silent partner. They don't usually reference them that way. They don't usually advertise them that way. No one says I'm looking for silent partners. They say I'm looking for limited partners. They always kind of whisper the limited, shout the partner, so that people feel like they've got some say in this, but you actually don't. And that's not a deal killer. It is what it is.
So I have seen a lot of syndication deals where the pitch is so great.
Right.
And the idea is so great. I mean, let's face it. If somebody came to you and said to you 15 or 20 years ago, listen, there is going to be this platform. Actually, let's say let's say 35 years ago. Okay. That puts us in 1985. There's going to be this platform in, what is it? 30 years that is going to have so much influence on the world around it that it's going to impact the actual presidential election and
Right.
allow the election to be manipulated. If you put down, $100,000 today, you're going to wait 30 years, but that'll be worth, $10 billion. Here's what it is. It's a little computer thing where people talk to each other online and you can connect with all your friends.
Right.
And
See, people wouldn't even understand that because back then the internet was barely a concept.
Exactly. It doesn't seem feasible.
Right.
So, and sometimes somebody will paint this amazing picture of what the outcome is going to be. You have to ask yourself, hey, look, is buying this commercial building or buying this large residential space and making it a high-end condo conversion in the ghetto, is that really a good play?
Right.
Hey, the projections look good, but what, is it a really good play? And then the last part of the plan that you got to look at is, are the financial projections, number one, detailed, and number one, accurate? Are they projecting a stagnant tax climate? And that the local municipality is about to jack up taxes 50%, or you got to look at that kind of thing. What is the outlook for construction? And what are some of the costs that you could expect? You might even, if you're researching a deal, you might even reach out to local commercial contractors doing this type of work. Say, hey, look, I'm looking at a project that's 50,000 square feet or 100,000 square feet. What's your general cost per square foot for new construction or renovation? And, just as a general number to get an idea if they're in the same ballpark. And then, besides the plan, you got the sponsor. Sponsor's a big deal. We talked about the operator yesterday and, how important they are as part of the plan. Can they execute? Are they honest? And have they performed in the past on similar deals? So, I mean, big parts of the puzzle.
Absolutely.
Next thing to consider, lack of liquidity. Judah, you want to talk about this one a little bit?
Yeah, I just think this is really important because I have been a sponsor of several syndications and participated in a bunch of syndications. And I see a whole lot of people talking about pulling money off their line of credit to invest in a syndication. They're like, oh, well, it's only going to be, this one's a little bit shorter. This is only a 2-year deal. I can
Yeah.
make the payments on my line of credit. What you need to understand is, number one, when you buy into a syndication, you can't sell those stocks. So if you buy a whole bunch of Apple stock tomorrow, and then your life goes haywire and you need to liquidate that stock, you need to sell that stock so you have the cash back, even if it's at a little bit of a loss, so you can pay for a medical emergency or you lost your job or something like that. You can do that with publicly traded stocks. These are privately traded or closely held entities, and so there is not a marketplace for selling them.
Well, and a lot of times in the terms of the operating agreement, there will be a first right of refusal, and there'll be terms that describe, if you want to sell, here's the process of valuing the stock.
Right.
And then, probably the GP has the first right of refusal. Then the limited partners have the second right of refusal. And if you have to liquidate beyond there, they have to be approved by the stockholders. Well, here's what really sucks. If the GP values the company at 50% of what he raised, now
Right.
all of a sudden your stock value decreased by 50%.
Right.
And that's a legit concern.
Yeah. The other thing that you have to remember is so I mean the rule of thumb is you should never put borrowed money into a syndication. Never put borrowed money into a syndication. Um, and you should also, unless it's like, I mean, the only thing that I would say potentially about that is if you bought a house for $50,000, it's now appreciated to $200,000 over the past 15 years, and you paid the mortgage down to $10,000, and you're going to refinance that house and pull a bunch of money out to reinvest, and that was money, and the property cash flows on its own. That's something a little bit different. But you want to be very, very careful about and just not use levered money in one of these. And
Well, so yeah, the other part of that is the capital calls. So one thing that people don't often understand when they get into these partnerships, they're real partnerships. So if you have this company and the projection is they're going to spend $1 million on acquisition and then development, and they're out of cash and the project's not done, what oftentimes happens is they'll do a capital call and they say, we need another $500,000. And Judah, you put in 250,000 the last round for that million. So you got 25% of the shares. I'm going to need from you another $125,000, or we'll raise that money elsewhere, but you're going to lose part of your shares. Your shares will be diluted.
right.
And you end up losing money on that end. Since you don't have a lot of control with that, it's really frustrating. I mean, I did a large capital raise with an LP deal in the past, and we had these guys come down from New York who, we took them around town, talked to them, and talked to these guys at depth. And they in Manhattan, if you're flipping a building, sometimes it might cost you $10 million. And with the expectation that your return is going to be pretty darn big. Well, they were talking about these deals that they were getting involved with, and on almost every occasion, there was a capital call at some point throughout the process, and they even built it into their calculation when they were looking at investing in these projects, because inevitably there would be additional fees with the city. Inevitably, there would be additional construction costs that they didn't anticipate, and right. Things that would come in, and it was just part of doing business.
Right. So a capital call, Stephen, just to answer your question, yes, you still make money even if there's a capital call. It's just that you then have poured more money into that project. So we've all had. I remember my first $45,000 rehab. Do you know why I remember my first $45,000 rehab? Because it was my first $35,000 rehab. So that happens, right? So I still made money on that deal. I still made a lot of money on that deal. However, I did not make as much as what I was projected to make. So if a syndication deal looks just like a normal flip, where there's more zeros involved, and sometimes so many more zeros, there's an extra comma. So you buy it, you do something to it, sometimes physically, sometimes operationally, sometimes, rebranding, whatever. So there's a rehab or switching over of tenants or just raising rents, whatever. So you buy it, you do something to it, and then you refinance it or sell it. And usually the time between there is about 18 months to 2 years. So during that period, if they lose a bunch of tenants that they weren't expecting, and therefore rents go down and they can't service the debt, they need to raise, another $50,000 or $100,000, or they start opening up, walls, and the rehab costs end up costing more. There are all kinds of things that could go into why you would need to do a capital call, but it still can be a good deal. Maybe just it's no longer going to be as good a deal. You need to know about capital calls. For a good operator, they're pretty rare.
Yeah. All right. Last but not least, so we talked about making sure that the plan is feasible, and there's a realistic expectation of not just getting your money back, but of making money. We talked about your capital being tied up, and then the third thing here is the timeline. So whenever you're talking about a drawn out timeline for an investment, there's a lot of uncertainty. I can tell you pretty well what the weather is going to be like tomorrow.
Right.
Pretty much. It might be sunny, it might be cloudy, it might be warm, it might be cool. If I got to tell you what the weather is going to be like on October 7th, 2021, I can make a decent estimate. But now if we look in 5 years out or 3 years out, look, I don't think that we're going to have 90-degree weather, but it could happen.
Right.
In the same way, you don't know what is going to happen in the future. Even the best laid plans, there can be things that trip you up. There can be changes in governmental, governmental rules and oversight, permitting process, construction. You can have vendors that, I mean, I've even seen situations where, maybe a general contractor, the owner of the company gets hit by a bus.
You can also have problems where where the globe is hit by a pandemic. Can and entire segments can get shut down. I
Right.
remember one time I almost bought and then rented back a car dealership, and I was putting together some partners to do that, and like pulled out just before for a number of technical reasons, but ended up not doing it. And the one partner was like kind of dragging his feet the whole way. And he was like, I don't like that this is a single occupancy. I don't like that this is a single occupancy. I don't like that this is a single occupancy. And sure enough, like like 2 weeks after we pulled out of that deal and didn't do it, is like in 2005, 2006, when the entire car industry took a nosedive. And remember, like the big three executives, had to, show up in Washington to justify their existence and everything like that. Do you remember that? Like back in the mid to early 2000s.
Yep.
So
Yep.
There's all kinds of reasons. And who thought that the American car industry was in trouble before that? There's all kinds of things that can come along that even under the best laid plans, you can have a problem. And a good operator is somebody who can say, okay, I had a plan, unforeseen events happened, and we're going to shift and pivot, and this is what we're doing now.
That's right.
Because it's how can we make money even when something came up that thought we weren't going to. Stephen asked another really good question here. Is the inverse true? Can you also make more money than was projected?
Sure.
Heck yeah. I did a deal in Tulsa, Oklahoma, where we flipped a 342 unit property. The initial plan was not to flip it. The plan was to refinance it and hold it. But we did so good on the rehab, and we're able to raise the rent so much that we had basically unsolicited offers come in looking for us, looking to buy it. So we were able to cash out and move on, and everyone ended up being really happy with what we made on that deal.
Yeah, there's obviously the opportunity for uptick here. When you have a really good operator, they're going to underpromise or promise the reality and then deliver.
Right.
What you see oftentimes, though, I think more and more nowadays, maybe more than in the past, is that you have a lot of newer people coming into the space, right? And so they're giving their best laid plans, but they don't have the foresight and insight because of that you get from experience to be able to say, okay, these things can happen. And so they're a little bit more optimistic on rents. They're a little more optimistic on timelines. They're a little more optimistic on some of the things that can happen. And because of that, sometimes plans get strewn out. And frankly, look, if you can hold an investment for another 6 months and increase the value by another 20%, wouldn't you want to keep it?
Right.
Like, and there are times when that's the best play, and it's just the uncertainty of knowing, hey, I thought I was going to get my money back in 24 months. Now we're at 30 months, and like it might make sense there, but it might not too.
Yeah. A business mentor of mine said once that smart entrepreneurs, people who run companies with, 50, 100, 500 people, they know what they are going to do in the next 12 months. They've got a plan laid out. They know what's going to happen, barring a global pandemic. They know what's going to happen in the next 12 months. They've got some ideas of what's going to happen between month 12 and month 24, but really, the economy is so uncertain as what is actually going to happen, the commodity prices, and there's just so many technology that may come out or be phased out or whatever. There's just so many things that could happen that 12 months, 24 months is really difficult to project. And then he went on to say that anybody who tells you what's going to happen 5 years from now or more than 5 years from now is guessing, and they don't recognize how stupid they are, or they think you're stupid. One of those two things. Anybody who tells you a number of something that's going to happen 5 years from now, it's like, we're reading today about how low oil prices are and how, ExxonMobil is, a shell of what it once was. No pun intended there for Exxon's competition. And, where we were talking about peak oil 5 or 10 years ago and running out of oil and, all these problems, whereas now oil demand is at, such crazy low levels and things like that. We don't know what the future holds. So what's important to do is get involved with people who understand how to make best laid plans and how to have some flexibility in their plans and have a track record of success into the past.
That's right. It's that simple, right? Awesome. Hey, good show today. We'll be back here at noon tomorrow. Thanks for joining us, everybody. We really appreciate it. If you enjoyed the show, don't forget to like and share. Until tomorrow, go make some money. See you guys.
See everybody.